Welcome back to another episode of Unpacking the Markets. My guest today is Ayesha Tariq. Ayesha's had a very impressive career in corporate banking, after which she took a role as the head of treasury, managing a large portfolio. Now, since then, she's launched a consulting firm for CFO services, as well as an independent macroeconomic research firm, Macrovisor. So, as we know, the world of macro can be shrouded in difficult terms and complex concepts and data. The amazing thing about Aisha is she really distills everything down to first principles and the real basics. So, in this interview, we deep dive into how anyone can really understand the world of macro and where to position yourself given the current macroeconomic environment for success in 2024 and beyond. So before we kick off, please like and subscribe to this channel, or if you're listening on Spotify, rate this podcast 5 stars. So I hope you enjoy this as much as I did. Let's get into it. Where do you start when you're building a view on global macro?
Well, great question. So when we look at the macro, we talk about top down, right? So we talk about the big picture or the biggest picture. So initially, I used to look at bottom up. So I used to look at stocks and I used to look at the fundamentals, and then I used to work my way up. But increasingly I realized that a bottom up framework, while it works, it's great, but a top down framework is much better in this, or it works better for me in the sense that it helps me understand the environment that companies are in. It helps me understand, the different metrics that's going on and the different relationships in the economy. And then I drill down into stocks. So when I'm starting out, let's say I'm looking at a country, let's say we're looking at the US. So the first thing I would look at would be, how is the economy doing, right? So we want to know what economic growth is like. We want to know what inflation is like. We want to know what the policies are like. So right now, for example, the Fed is very, very important, right? For the longest time before, let's say, the pandemic, Fed interest rates were low. There was nothing much going on from the Fed. They weren't that important. But now that we've started this hiking cycle, it's obviously become much more important to understand policy. And that's the case all over the world. So we start with how the economy is doing, economic growth. We start with inflation, and obviously policies.
And I guess what gets important then depends on the regime we're in, is kind of what you just said there, is that the Fed becomes very important in certain scenarios, or it might be inflation in other scenarios, or economic growth in other scenarios.
Absolutely. So we look at the cycle, right? So the economy and and businesses, they always move in a cycle. And this cycle basically affects how businesses do, throughout time. So when we're looking at the cycle, we want to understand where we are in this cycle. So are we at the peak? Are we at the bottom? Are we recovering? Are we coming down? So that's basically what the cycle is like, right? So you have the main four, stages in the cycle. So, and understanding this, you need to understand the rate of change, right? So a lot of people talk about absolute numbers when it comes to macro, but what we really want to look at when we're looking at, the macro situation is the rate of change. So is growth increasing or decreasing? Is inflation accelerating or decelerating? So that's the kind of thing that's, important to remember. And there's one more thing that I want to add here. Remember that the macro, or the way that the cycle moves, can be quite slow. So often enough, we look at situations in the market and we say, oh, the macro doesn't matter. And we say that because it feels like, each data point that comes out probably isn't influencing the market as much. But in the grander scheme of things, it does influence the market, right? And so the cycle moves very slowly. And then we're within the cycle, moving up and down with the market and with companies and, consumer spending and so on and so forth.
Yeah. And when individual macros, data points, are not influencing, say, price as much as they should be, is that because we're being dominated by, say, another narrative or some other bigger piece of macro that's kind of driving the market?
So it could be. So, for example, and to your point, AI, for example, is a narrative that has been driving the market a lot, right? So,
Mm.
AI, though, is one part of it. So, when you look at what happened in 2023, for example, after 2022, people got scared, right? So, the market went down quite a bit in 2022 after the 21 high, right? And so people started getting worried about what's going on. Um, and the data points were not looking as great. The Fed was still hiking, right? And we like interest rates were going up. People were getting scared that, something will break in the system. We saw an issue with, the regional banks, if you remember. So all these things kind of drove people into these mega cap stocks. And so I want to say that the start of the mega cap stock rally was because people were afraid and they needed to hide out somewhere. And where do you want to hide out when you're afraid? In quality, right? So, and
Mm.
these were like the best of the best, let's say. And so everybody started to move towards quality stocks. And then what happened? The AI, story started developing. I want to say around May, June, I think, or even slightly earlier.
Yeah.
And then, so it was very coincidental, let's say. So the AI narrative kind of helped these stocks do better as well because they started, talking about it, and everybody started feeling okay. So there's growth here, something's coming. So it was more coincidental than anything else. But at the same time, I want to say that what sparked the rally was the fear that the market is going to go down again.
Mm. Yeah, that's interesting. I mean, how do you get a feel for fear in the market? I know some people use, say, VIX as a kind of lagging indicator on how volatile markets are or how fearful they are. But when you talk about, anticipating people looking for safety in, say, mega cap stocks that have a lot of cash or are good quality, how do you get a sense of how fearful the market is at any kind of one point?
So you're right. There are various indicators. You have the VIX, and then there are other banks and that sort of publish these fear gauges, bull bear
Mm.
indicators. You have retail AII retail bull bear indicator, like how bullish the market is, how bearish the market is. But you know what, Con? On a daily basis, that kind of produces a lot of noise, right? So we do look at the market week to week, and we do look at the market in terms of momentum from week to week. But at the same time, the reason we like looking at the big picture is because we want to drown out a lot of this daily noise, right?
Mm.
So at the end of the day, you want to, okay, there may be fear in the market, like from one week to another or from one data point to another. So, say you have inflation data coming out and it's not as good as you had hoped. Immediately the market reacts, right? But from there, the market does recover again. Now, in 2022, a lot of the times the market didn't recover and we saw heavy, heavy, heavy drawdowns. The way to see that coming, obviously, again, is to see what the Fed is doing, where the economy is heading. So the economy was still strong, but the Fed was hiking, inflation was high, and it was market sentiment that, conditions are getting tougher, right?
Mm.
And so one way of looking at that would have been to look at how the macro was behaving, how the Fed was behaving, where is inflation going. So when you look at those big picture items, I wouldn't say it's easy, but you get a sense of where things may generally be going, right? And obviously with that, interest rates and everything else that influences the market.
Mhm. That kind of rate of change over time, I guess, yeah, that gives you a good
Absolutely.
sense. Yeah,
Absolutely.
yeah. And you mentioned a bit, say a big data point coming out, like say, big CPI last week, market
Yes.
reacting. how do you, because I mean, lots of people have macro views, read lots of them, but there's also then the market, which is kind of almost like a separate thing. So I see a lot of people kind of get very carried away in macro, but then the market is behaving completely differently. How do you
Yes.
kind of stay grounded in what the market's doing and make that link between macro and the market?
So, first of all, I've made that mistake as well. Okay, getting carried away by the macro and thinking, the
Me
macro
too.
is end all for everything. But we all make mistakes in our journey, and that's why we want to learn from them, right? And so, what I learned is macro is just part of it, right? So just as before, I was making a mistake, sort of doing very heavy bottom up kind of research. At one point, I started getting too heavy into the top down research, right? And so
Right.
I think what you need to try and do is always strike a balance, right? Right now, we have several other forces in the market. So we started having these options, which expire every day for the index. And that kind of moves the market a lot. Now, some of these things are a little bit more complicated to follow or a little bit more complicated to understand. But what you need to take away from this is exactly what you said, that, sometimes the macro is overarching, it moves very slowly. So you get a general sense of, let's say, where everything is going with the macro. But then from getting from point A to point B, you still need a more detailed map, right? And that's when you're following the market on sort of a more weekly or 2 weekly basis to understand what kind of trends are taking shape.
Yeah. And if there's a delta between what you see in the macro and what you see in the market, is that kind of an opportunity for you? Do you see it, or maybe a potential opportunity?
Absolutely. So usually the market sort of always kind of moves a little bit ahead of the macro. And that's another thing that, we kind of learn the hard way, along the way. Because I'm not the only one looking at the macro. You're not the only one looking at the macro, right? So we have all these big boys who are looking at the macro as well. They have economists, they have teams of people, right?
Yeah.
And so it's not just you and me that's positioning for it. So quite often what you'll see is, okay, sure, a data point may come out next week, next month, whatever, but a lot of people position ahead of these things, right? So quite often the market moves faster than the macro moves. And so, understanding where the market is also going is a good way to sort of see how everyone's positioned, if that makes
Mm.
sense.
Yeah. Yeah, definitely. Yeah. And I mean, you mentioned a couple of lessons that were hard learned. I mean, your trading journey, I think when I was doing my background research on you, started. I mean, besides you have a background in money management post your banking career, right, and actually managing the flow and risk.
Yes.
Um, but what have been the kind of hard lessons you've learned in the world of, I guess, catapulting forward to macrovisor and your kind of independent research on macro and then marrying that with your trading?
Well, um, so again, I want to say don't get married to a view, right? So
Okay.
sometimes what we do is we want to prove ourselves, we want to be proven right, okay? And the market doesn't care. The market doesn't care whether what your view is or what my view is. It will do what it will do. So at the end of the day, yes, you can have a view. It's great to have a view, and that can probably help guide you. But remember that you need to be nimble, right? So as the market is changing, as the macro is changing, it's important to be able to update your view as you go along. So that's something that you should always bear in mind. So with I wouldn't say with every data point, but with every sort of change or move in the, economy, you want to sort of update where your thought process more than anything else, because you don't want to get stuck in one view and then try to start becoming arrogant about that view that, hey, the market's going to go down, the market's going to go down, the market's going to go down, and all the while you're holding on to shorts while the market is shooting
Yeah.
higher and higher and higher and higher, right?
Yeah.
So, and on the back of that, I would say, you need to have stop losses if you're trading. Okay, it's very important, especially if you're a new trader. And B, yeah, you need to know when to get out, even if it's at a loss, right? So it's better to take a smaller loss than to try and be proven right and hold on to that and then end up, making a bigger loss down the
Yeah.
road. So I
Yeah.
know a lot of people who say that, oh, if you put stop losses, what happens? You start to take losses. And if I had only held on a little while longer, then I wouldn't have, the stop wouldn't have triggered. I wouldn't have lost this money. Sure, you can say that. But what happens when the market goes the other way and keeps going the other way? And the market can do that. And we've seen that happen, right? I know a lot of people who tried to short the mega cap tech last year. They got burned badly.
Yeah.
So, particularly if you're a new trader, I would say try to keep a stop loss. If you think that the market will be slightly more volatile, increase, the level where you put your stop loss. But at the end of the day, risk management is very, very important. So don't get married to a view. Yeah, update your view as we go along and always manage your risk.
Yeah, I laughed when you were speaking there because it reminds me of a hard, what's a hard knock, but when Japan came out raising rates earlier this year, I
Yeah.
kind of had this really bought into this kind of reduction in carry
Mm.
narrative, and I was like,
Yeah.
this is going to catch on, essentially bullish yen and bearish
Yeah.
cross yen. So, um, this is what, like 3 months ago. And obviously we had the intervention, but at the same time, yeah, there was some short money to be made along the way. But I definitely feel like I got married to that view because yen just kept weakening. The market didn't really care
Yes.
about the BOJ signaling that there will
Yes.
be strength. It just kind of powered through, as you said, not caring about my view. Yeah. Yeah.
So that brings me to another very good point there, because I'll tell you what happened there. They cut rates, or sorry, they hiked rates, but they hiked rates by, let's say, a very nominal amount, right? So it was a very token amount. The bigger issue there was their bond purchases. So they continued with their bond purchases, which kept, conditions easy in the market, right? So there was plenty of liquidity, and that sort of drove the yen lower and drove the market higher. So this brings me to a very, very good point. Knowing everything. First of all, we can't know everything. We are humans. Unless we have like a massive, massive team behind us, we can't keep track of everything that's going on. So, quite often, just understand that you will miss things here and there and things that may influence the market and things that may be important. We try at Macrovisor, we try to cover all of that. But again, we are a smaller team and there's only so many hours in the day that we can work to sort of provide that kind of information. And so everybody misses things. Even the big guys miss things, right? So Morgan Stanley missed the fact that, there was still government spending in the economy. So everybody misses things. So that's one. And so the way the which the thing that the point that I was trying to make was that there's always something that may influence the market which you may not be seeing. So again, that's another good reason for you not to always get married to a view, because your view may have been right. Technically, you were right. Your view was right. But there were other influences in the market and other things going on which sort of you didn't, let's say, account for, which is
Yeah.
why the move happened the way it happened, right? So
Yeah.
always remember, we can't know everything. And so there
Yeah.
may be other factors that may be playing on the market. And so that's why it's, again, very important to update your view and manage your risk.
Yeah, and I think that's the key. It's like if the market continues rallying against your view, when is your view wrong? And having that kind of outlined in advance. Just said beyond this
Correct.
point, maybe it's a stop loss or yeah,
Yes.
ideally a stop loss, so you don't have to think about it. But at
And
this point,
again, I'll tell you, Colin, you weren't wrong.
yeah,
Your view was not wrong, right? So this is the problem. This is where we we start getting married to the view that
mm,
I know I'm not wrong. Fundamentally, technically, theoretically, I am right.
yeah,
But what you probably didn't account for was the other factor coming in, right?
mm,
So this is something that, we all have biases, we all have issues, and so something that we need to manage is that we can't know everything. So that's something to always remember.
yeah. And the hard truth being, you can still be right and lose money, right? So,
Yes,
yeah.
absolutely, absolutely.
Yeah. But going back a little bit towards macro, although we never really left, has there been anything that surprised you in 2024 in terms of global macro?
um yeah, I mean, right now what's happening in Europe, this is a little crazy because the ECB cut rates, and obviously the markets were doing quite well in Europe anyway, and
Mm,
so everyone's view was, okay, so the ECB is going to cut rates, the market's going to be stable, prices are going to be supported. A lot of that came, ahead of time because the ECB was very good at, telling everyone that they're going to cut rates in June.
mm,
And they sort of backed themselves into a corner also a little bit into cutting rates. But
yeah,
at the same time, I think, it was kind of smooth sailing, right? So for Europe, nobody actually saw like any severe problems coming up. And
mm,
then you have these elections, which was, yes, an event, but it wasn't meant to be an event that was going to crash the markets like this. I mean, what's happening in Europe is, okay, not a crash, but it's a strong correction right now, especially with France. And so I think, the political situation is what's surprising me this year. A lot of the things that were sort of baked in or taken for granted, sort of, surprising us. Mexico is another one. We were very bullish on Mexico, and you know, the president who won the elections, she was supposed to win. It wasn't a surprise. And yet the market took it very, very negatively. So the
yeah,
peso fell, the markets fell to a 4-year low. Again, India, another one, right? So the prime minister won a third term, but he didn't win by a majority. And so that put pressure on market. South Africa, another one. So I think, politics is sort of, I want to say that's kind of what's surprising me the most in the global macro situation, with Europe being like the latest big surprise, let's say.
yeah. And I think politics, full disclosure, is definitely one of my weak points in terms of just being knowledgeable. I never really, I guess, cared enough to build a decent knowledge in it, but starting to see, especially this year, how important it is. But
Hmm.
heading into elections, like in the UK, we have an election coming up, and
Yes.
obviously, yeah, and all the elections you've mentioned, you must have been, I guess, maybe managing risk or anticipating certain outcomes for asset classes, or just trying to position around elections. So, could you talk a little bit about how you do that? As in, how do you position yourself in terms of your risk heading into an election?
So the truth is, we didn't really manage it very well around Mexico. But yeah, so for India, for example, yes, the markets went down, but I wasn't worried because we have a more longer term view on India. And one election is not going to change that view. And sort of, I even wrote about that, like I wrote a quick update after the markets went down, that we're not panicking, and that's because we have like a more long-term view on India.
mm,
On Mexico, after the elections, I had to change my mind, and we have, like, what we're saying now is we want to avoid Mexico because the policies there have changed. So the truth is, you can't always position for these outcomes,
mm,
but what you can do is manage your risk. You can take your risk, down, let's say. And that's not just for elections. I would say we should do that for any big event, right? So
yeah,
any big event, whether it's a macro event, elections, geopolitical situation, you want to sort of balance your risk. A, you can take your position sizes down, take some of your profits, get out of there. B, you can sort of put on hedges if you are comfortable with that sort of thing.
mm,
And C, for global, political situations, obviously, people like to buy gold, dollars, um, and bonds. So I wouldn't buy bonds right here, but yeah, just a little bit of gold and perhaps silver and dollars, or going to cash, let's say, is not a bad idea.
yeah. But in the India example, right, I guess you had a longer term view on India, and then
Yes,
you're not so caught up in the noise. Maybe you even saw it as a buying opportunity post election, because you
actually, it
had that
was.
frame. Okay,
Yes,
yeah, very good.
actually, it was.
Yeah, yeah. But shifting, staying on the politics topic, but back in Europe, right? So the kind of, I guess, rise of slightly more right-leaning political parties. I mean, Le Pen in
Yes.
France. It was the same in Germany. How do you think that fares for Europe economically? Do you think that is going to have a big impact on the European economy going forward?
Yes, it will. So we put out an article last week actually about this, and the issue with these parties now, and I don't want to speak in too much detail because it's not like I'm a political expert either,
Mhm.
and I don't like politics actually. So I don't, like you, I don't have very in-depth knowledge because I just simply don't like it.
Mm, yeah, yeah.
But it does influence the markets and it does influence the economy. So we do need to understand some of it. So from what I understand and the research that I have done, these parties are, let's say, they want to increase spending in many ways, cut taxes, and all of this sort of brings you back to a situation where you are looking at fiscal spending, right? So you're looking at government spending. Now, the whole problem with, okay, so in Europe it was slightly different, but government spending, fiscal spending is an issue and it works counter to monetary policy or increasing interest rates.
Mm,
And that's something that if you listen to President Lagarde when she gives her ECB press conferences, she has been very insistent on this issue that countries need to rein in their fiscal spending and they need to have proper fiscal policies that are not working counter to what they are trying to do, which is sort of manage inflation, manage costs, manage increasing prices in the economy.
mhm,
So it's a bit of an issue, and if they do start these fiscal measures, or if they do start fiscal spending again, that could sort of push these governments into further fiscal deficits. So, for example, France has a debt to GDP of about, I want to say, 109 to 110%, which is
mm,
quite high. Same with the US. Obviously, the US is 120 or so, also. So these kind of spending policies at this point in time, they could spark another bout of inflation because, as long as you have money in the economy, that could be a big problem. And then on the other hand, you have a situation where because your debt is so high and interest rates have gone up, you have a huge interest cost on the government. So the government, what starts to happen then, the interest burden starts to increase, and the government's ability to actually spend on healthcare and education and defense, that starts to go down, right? Unless you're going to increase that deficit again. So it's not a
Yeah.
great situation to be in. And so I'm not saying that these guys will necessarily implement those policies, but that's the idea. That's the idea that they're coming with, that they're going to cut taxes. They're going to, sort of make it easier for people. But the problem with these kind of things is it's sort of very short term. So you are relieving short term pain, but you're causing a longer term problem.
Yeah.
And that's where the issue is.
Yeah. And I guess it makes sense why French bond yields have really pushed very or significantly higher the last couple of weeks, or I guess last week in general, right? Because if, as you said, their French debt levels are reasonably high in relation to GDP,
Yes.
um, yeah, higher yields are going to
Yes.
impact them and put pressure probably on their banking system. But I would say, do you think it's I guess something that can be contained to France, or do you think it's something more systemic that the euro, for example, would need to start worrying about? And we've seen some selling in the euro already, but I guess I'm trying to think, where does it end, right? This selling, because as you said at the start of this conversation, Europe was doing
Yeah.
okay, right, for a while, and then we've had this political risk, and now the euro is sold off. But I'm trying to think at what point does this end up being a wider problem that will continue on for Europe?
So the thing is, right now, the way it's looking, the euro could actually go down to parity again. So that's something to bear in mind. So our view was, let's not touch this right here, because it's very unpredictable. The reason that yields are going up and the reason that CDS, so credit default swaps, are going up is because there's extreme uncertainty in the market. And unless you're like either taking very short trades to profit off of, like, short term, very, very short term views, like opportunistic, or you're an experienced trader, I would say, just stay away from this for a while, because the uncertainty is extremely high. And
Yeah,
so it's not just a normal situation where markets are going down, they'll come up again. We don't know what's going to happen. Elections are at the end of this month, and I think 7th of July is like the second round. Post summer, we're meant to have regional elections in Germany, so that could spark another round of uncertainty. So it's actually a little challenging here. Europe was actually looking very good in terms
yeah,
of the markets and in terms of equities, and it was big, shaping up to be like, okay, this is it. The markets are fine. We're like smooth sailing from here. And the macro was playing out pretty perfectly over there. Um, Unfortunately, this situation has brought in too much uncertainty at the moment. And I would say just either be like, even if you have positions, take them down and, just be very, very careful.
yeah. No, I agree. As much as the contrarian in me wants to say, okay, this is it, it's going to reverse from here, etc. I think you're some wise words. Um, but I mean, we've talked a lot about Europe, so I want to shift a little bit to the US. Right, we had the FOMC last week, and the dot plot come out with a couple of changes. Say one
Yes.
cut now priced in this year, and from 3 to 4 in 2025. Uh, but I'd love to get your take on Jerome Powell's commentary at that press conference, or how you interpreted that, because I found that quite hard to interpret. A lot of people were saying it was hawkish, a lot of people were saying it was dovish. I was kind of thinking, right, let me get a real an expert here to tell me what it was.
Well, I think it was confused. So I feel like they're at a point now where they're not sure what's happening next, right? So they got very, very dovish in December. They thought everything was going to be smooth sailing, you know. we're on the right track, inflation's going to come down. By the way, our call in December was that inflation would reaccelerate. Okay, so it hasn't really reaccelerated as such, but it hasn't gone down either, right? So this was something that we were kind of expecting, because inflation never goes down in a straight line. And this, it wasn't just us, quite a few people were also talking about that it was going to be like, there was going to be a resurgence. And we're kind of seeing that again. I think they got too dovish too early. And so now they're having to sort of eat their words a little bit and walk back what they had, thought they would be able to do very easily. So just like Europe, they thought they would be able to navigate this cycle very smoothly. They would start cutting maybe in July or September. Everything would go like hunky dory, and it all seemed smooth sailing. But again, other factors started to come into play. So let's say even they didn't see a few things coming. And what I took away from this press conference is they are confused. So they increased their, expectations for inflation, the projections, to a level which is higher from where we are. So they increased it to, I want to say 2.8, and we're at 2.7 right now. So it's like they feel inflation is going to go up again. And that could happen because we are looking at a period of, base effects, which could sort of keep inflation sticky for a while. As well as shelter inflation is not going down the way we had hoped. And that's like the largest portion in inflation, right? It's 35%. But at the same time, he was very encouraged by the CPI data that came out that day, the same morning, right? So I think they're trying to balance risks. They're trying to walk back what they did by going too dovish and easing financial conditions too much, too quickly, which sort of gave rise to another bout of, let's say, sticky inflation. And they're just trying to be careful from here on out. So the market is saying they might cut twice this year, and they just might. They might change their view. But I also think that they're going to be careful, because I don't think they want a situation where they start cutting too soon and inflation sort of explodes.
Yeah. Yeah, and I read in your weekend edition a couple of weeks ago when you quoted Paul Volcker.
Yeah.
So you mentioned shelter inflation, but when you talk about inflation reacceleration, what are the kind of skeletons in the closet you're thinking may cause problems for sticky inflation going forward? Is it just shelter inflation, or is there other things behind your view?
So at the headline level, we are seeing commodity prices still remain quite high, right? So, okay, the rate of change has become negative in oil prices or energy prices where inflation is concerned. But again, oil prices really haven't gone down. So if you look at it, yes, it's fluctuating. It's not above 80, but it's not going down below 78. And we're coming up on a period where oil prices go up because of the summer season, right? So that's something to be concerned about. Again, we have issues with wheat and corn. We're seeing commodity prices stay high there. Weather conditions are actually putting pressure on, harvests. So there is, quite a few factors at the headline level where it could push prices up in terms of food and energy.
Yeah.
And then at the core level, you see wages have not decelerated the way they should. So there was this idea that because of AI, we'll see productivity improvements. And perhaps there has been some, but not to the level that, one would hope. And so, and the market the labor market is still what they call tight, right? So there are still more jobs available than people, and that's sort of pushing or keeping wages at a certain level. And so as long as you don't so this level of wages, so we look at the employment cost index, which comes out every quarter, and as long as that stays above, let's say, 2.83%, it doesn't really support an inflation level of 2%.
Yeah. And just on that topic of labor markets, before we keep going, in one of the interviews I watched with you, you mentioned when you got into kind of independent macro research, you were really looking at what's behind the data, right?
Yes.
And when we talk tight labor market, we can talk about the spike in non-farm payrolls recently after we had trended down for a while. But I've heard a lot about people questioning the non-farm payrolls number, right? Can you
Yes.
expand a little bit about what's behind the data in terms of non-farm payrolls?
Okay, so first of all, let's just put it out there. These are not perfect measures, okay? Because these are done as surveys. Over the last couple of months, some of the survey, like the rate of answers, or like the number of people answering these surveys, have been kind of unpredictable. So they're not,
Oh,
let's say, it's not perfect data, first of all.
hmm.
Secondly, with the non-farm payrolls, this is why you kind of get a lot of revisions afterwards, right? So when you look at every month's release, at the bottom of the release, you'll see that, they said, oh, we revise, last month's number down this much, and we revised the previous. And then so for the non-farm payroll, you have what we get on the first Friday of every month is the first estimate. And then you have the second estimate. And then you have a third estimate, which people kind of forget, but it's there. So the revisions keep coming for a few months. So it's like I'm getting last month's data on the first Friday, but this may not be the right data. So
Right.
by the time you get kind of close to the right data, you're like 2 months down the line already, and then you're looking at. So it's kind of a weird process, and so this is why people sort of question that data, because there are multiple revisions. The data you're seeing may not actually be the right number, but the truth is, it's what Chair Powell said in his press conference, that this is the data we have, right? We can't always reconcile what's happening. And yes, there are revisions. So yes, it's difficult to fully trust the data, but at the same time, this is what we have. And so we have to sort of depend on whatever we're getting. And that's why when a lot of people keep saying, oh, but this is not what it actually is, this is what it doesn't actually show, it doesn't matter in one sense. Is you need to understand, what is the Fed looking at, right? What is the government looking at? What are banks looking at to position themselves? They're looking at that one data point.
Mm.
So whether that data is 100% right or wrong, we can debate that for another 2 hours.
Hmm.
But the point is, what are people looking at, and how are they positioning themselves based on what they're looking at? So the data might be 8%, but in real life it might be like 4%. Doesn't matter. For people, they're looking at the 8% and positioning based on the 8%, not based on what the actual 4%.
Mm. That's really interesting, as a perspective that even if it's not 100% correct, because that was my, I guess, a little debacle recently was, oh, a data point comes out, how reliant is this data point? Um, but I really like your perspective there that it doesn't necessarily matter if everyone is treating that data point as if it's correct. Everyone believes it's
Yes,
true, so it's true kind of perspective.
kind of. I mean,
Yeah,
and again, even if it's not true,
yeah,
it depends on how I react to it, right?
mm,
So what you want to understand is, okay, how valid is this data point? I mean, not whether it's correct or not, but how valid is it, and how much importance will people assign to it or the market assign to it?
Yeah.
And so that's all that matters. What the market is seeing, not what the actual data is. Now, for people like us who do the work with a lot of intensity, sure, it matters. We want to look at it, we want to understand it better. But again, we have to bear in mind, what is the market seeing?
Yeah. And because there was such a light on labor, say at the last FOMC, what do you, I guess, use or look at in terms of data points to get a good, well-rounded view of, say, the US labor market?
The same things. Honestly, I mean, we look at the unemployment report just like everybody else does. I do like looking at the employment cost index, the one that I talked about. That comes out quarterly, but that's gives me like a very, very good sense as to where wages are. And that's basically what, so wages are like the price of labor, right? And so you want to understand what the price of labor is to understand which way the market is moving. So if the price is still high, it will influence demand and supply. So when you break it down like that, look at it very simply. Everything in this world comes down to demand and supply and price, right? And so that's why looking at the wage level can sort of give you a sense as to which way the market is moving.
Very good. Yeah. To shift a bit to oil, which came up a little bit earlier. Now, you have a kind of short-term, I want to say, bullish outlook on oil. So can you talk about how you built that view?
Sure. So basically, again, we look at the data. So I looked at seasonality. Seasonality suggests that this is a time period when, the prices start going up. And then so you look at, you dig through more data and you realize that um, during this period between May and August, let's say it's driving season, summer season, and this summer is supposed to be quite hot. So the hotter the summer, the more energy is consumed. And I'm talking about globally. And so the requirement for oil during this period of time goes up by about 3 to 3.1 million barrels a day. So that means you have additional pressure or additional demand during this time. And then you start to look at the supply side, right? So you look at how much production is coming in or how much production, may be coming in. So you look at the OPEC numbers, you look at the IEA numbers. And that kind of gives you a sense of, how much production may be coming in. Now, there's always a surprise or two in there, obviously. But at the same time, these numbers are pretty, I want to say quite accurate. And then you also want to look at your existing inventory. So last year, for example, we had, those production cuts coming from the OPEC and all of that. So prices actually went up quite a lot. This year, we don't see prices going up that massively, but we do see prices like remaining sticky. So we're for WTI, which is the American oil, we predict about 78 to 80. And for Brent, which is global oil, we are looking at about $83 per barrel for the summer season. And that's because inventory levels have been, well supplied. And that sort of takes the pressure off from the supply side, right, when the demand goes up. Plus, we're looking at demand in China as well. For the last couple of months, the demand in China has been quite low. We're not sure that will continue, but at the same time, we don't think it's going to be as it was before.
Mm. And I mean, you mentioned kind of everything is about supply and demand, but I feel
Yeah.
oil it seems to be that way. Particularly, I don't know a lot about oil, but is that how you approach any kind of view on the oil market? You just, I mean, frame it in terms of demand and supply, and then build your case around that frame.
Yes, for me, yes.
Yeah, yeah.
And yeah, so this is something that I do for everything actually in macro. I'm not an economist.
Mhm.
I was a banker. I actually didn't even study finance. I studied marketing. So for me, when I look at the macroeconomy and I look at economics, I go back to my basics and I break things down very simply for myself. And then so I try to help others with the way I learn. And that's to sort of break everything down into very simple terms, supply and demand. And for me, that kind of explains 90% of what happens in the markets when you talk about any kind of prices. So if you're looking at why, interest rates go up, why the dollar goes up, why commodities go up, everything sort of is driven by supply and demand, which gives you a price.
Mm. Yeah, it's honestly, yeah, it's again speaking honestly, it's definitely something I don't weigh. I don't know why. I think when I get caught up in the world of macro, there's so much going on, and this is kind of sophisticated and that and whatever. But when you bring it down to first principles, it's so true that it's just about supply and demand.
I think I do it that way because, again, I wasn't trained. And so for
Mhm.
me, I, what's the best way to understand something? It's to sort of break it down like a 5 year old, right? So the best way to understand something is to start with the basics and break everything down into basics. I think people have a tendency in the finance world, and I've worked in finance for 20 years, so I can tell you this. We have a tendency of making things sound very complex, very complicated, because we want to have that, we're a bit snooty, let's say. And we don't want people to always understand us because we want to seem very smart. And, these things are very, very complicated. They should go over your head. What we do is very specialized. And I'm not saying that some people don't do specialized stuff. Obviously, there are people who do like very derivative math and all of that stuff and bond math. But at the same time, much of it can be explained in very simple terms. You don't need to complicate things to understand the world of macro. And it's not as complicated as people make it sound.
Yeah, I think that's definitely one of your uh, drive or the drivers of your success is how simple you write things. It's just very consumable. And as you said, my background is also not in finance, although I do work in a bank. I work in IT, so it's not most
Okay.
people in IT. They don't. It's not necessarily their job to have that level of understanding. So I think, and to relate to a lot of those people, they echo what you just said in terms of everything seems so complex. Sometimes the only thing that makes sense is the code because the code is either right or it's wrong, right? It's binary. So,
Mhm.
um, but one other point you mentioned was seasonality in oil, and
Yeah.
because seasonality I've seen in lots of different places. I've seen it in equities, but just mainly in equities. To be honest, you're the first person I've heard to mention it in oil. So, do you, when you look at different asset classes, do you lean on seasonality as a kind of, I guess, maybe an edge builder or something to help you see or anticipate what might happen coming forward?
So it's definitely a factor, right?
Hmm.
So, and especially, for example, in commodities like um, uh, wheat and corn and all of this seasonality, I mean, that's where the seasons came from, right?
Yeah, yeah,
Planting
true. Yeah,
crops.
should have
Um,
realized that. Yeah,
yeah.
yeah.
So yes, I won't say it's an edge, but definitely it's something to look at, and it could help, right?
Mhm.
Um, because look, just because something's been happening for 30 years, it will happen this year as well. Not true. Okay, not always true. So you don't have 100%, guarantee on it. But at the same time, the patterns are there, right? And so we look for patterns. And this pattern has been playing out for the last 20, 30 years. And there's a high probability that the pattern will play out this year as well. And so, again, none of this is like 100% or science or any of that. So we always look for things in probability. So is the
Mm.
probability high that, we might have a hot summer and so more demand for oil? Yes, it is.
Yeah, and it's that kind of reminds me of a harsh introduction to trading and thinking in probabilities because, as you said, it just sometimes when it is in trading, it's unfortunately as basic as do you have any kind of a tilt in favor of your bet in this case. I don't mean to draw it back to gambling, but there are a lot of similarities. And
Mhm.
so yeah, I think it's one I'll probably use going forward. But seasonality in terms, it's not something I currently use, but I think there are good reasons that seasonality can be true every year. As you said, it doesn't guarantee anything, but it's not an accident if it's a tendency. I'd like to think sometimes.
Yeah, it could, and always remember it could be plus or minus. So just because the season starts in May doesn't mean that it will start in May every year. We could be
Mm,
early, we could be late. So it could be June, it could be April. Uh, but the likelihood is that the pattern is there.
yeah. And a last point on that oil demand you mentioned in particularly when your comments about China. So, I mean, China's been kind of, I don't want to say up and down, but it's come out of a very hard period and maybe still coming out of some very complicated issues with their property market and the kind of escalating trade wars that are happening between Europe now, or even Japan. I read a couple of weeks ago are threatening tariffs against China and the US. So, how do you see China's economy over the say the next year unfolding? Do you see it continue to improve or run into more kind of issues?
So China, okay, just to take a step back, China has sort of
Hmm.
made a shift in the way they're doing things, right? So they've changed their, like, say, motto from made in China to made by China. So basically, the whole idea is to move everything to more high tech industries. So they're focusing on EVs, semiconductors, stuff down the supply chain, which needs like far more high tech stuff, not like the basic things that they've been making all this while. So they have sort of been shifting the narrative for themselves. And that's why what you're seeing in the GDP growth at 5%, where their average growth has always been 8-9%. This shift downwards is because they're changing the way that they want to position themselves in the world, right?
Right.
Now, because they put so much emphasis on that, all of these other things that have been happening in the market, with their property market, their consumption, it's sort of really, really dragged down things for them. But at the same time, the GDP is on target according to them. And so they haven't really been taking the kind of measures that they should have been taking. So very recently, they did put out some property measures, but then again, it wasn't enough. So by some, statistics, you can say they've put out, I want to say, about 20% of what they should have put out. And then there's nothing after that, right? Today there was supposed to be a rate cut. There's been no rate cut. So there's no stimulus in that, or not enough stimulus in that economy to sort of support local consumption. And that's where the problem is. And then you have now these outside forces coming in, which is threatening their other kind of, focus. Their EV focus and their high tech focus is now being threatened by, trade wars. So I see a very bumpy road for China in the next 1 year. We were seeing the cycle improve in terms of, let's say, inflation, industrial production, and we kind of thought that this would continue until the end of the year, until Q4. But now we're starting to see the data go backwards again. So today, industrial production came in much lower than expected. And so I would be a bit cautious here on China. Consumption has not come back, and they need that to come back. At the same time, their export orientation is unstable. So we are getting some good data, then some bad data, again good data. So it's a bit tricky. And I think this recent surge that we saw, the 30% increase from February to, I want to say, early May, that's been a good run. We're seeing a pullback now. I think we should wait until this pullback ends before we enter again.
About 30% gain in Chinese equities, is it?
It was about that, yes.
Yeah, yeah. No, I agree. Because I saw that happen, and it was almost like, everyone's buying into this China recovery story, but it just felt a little bit more complex than China's back now, as you said, went into the different shift that they're doing. But I think, yeah, I agree that wherever the pullback ends, it seems to be a lot better than it was definitely last year or 2 years ago.
Yeah.
Yeah. Now, to bring kind of, I guess, everything together, right, and talk asset allocation going forward for the next year. So we've touched on definitely everything I wanted to talk about, right, and almost everything in the global macro world. Where do you see as good or reasonable places to be asset allocation wise globally going forward for the next year?
Globally. Okay. So globally, I said I like India. I still like India. UK, the UK is actually quite undervalued here, right? So we had a call on UK since March, still doing okay. But I think a pullback could, maybe after the elections, could be something to look at. So globally, we like the UK and we like India more, but also the UK. And then US markets, always solid. Within the US markets, my partner likes aerospace and defense, utilities. I still like a few industrials. So select industrials, we're putting out ideas here and there. And we are looking at various themes. I really liked healthcare for a while. Unfortunately, it hasn't performed the way we thought it would, other than a few stocks. But so I think the view on healthcare is a little more nuanced and more stock picking versus looking at the sector as a whole. But we, in general, like the reflation trade, right? So we're still seeing inflation remain sticky. And I think at least until the next quarter, we see the reflation trade still staying strong.
And when you say definitely India, what's your, I guess, base case for strong performance in India? Because I've heard a lot recently about a lot of people investing in India and its economic growth, the projections, and Indian equities are doing extremely well. What is it about India for you that makes it a good investment?
So obviously their policies. So over the last 1 year, they've been doing a lot of, not 1 year, but a couple of years, they've been doing a lot of infrastructure spending, but they're also shifting that a little bit to the digital side of things, right? So they're investing in data centers and they're investing in the digital economy. So that's one, definitely. Secondly, they are opening up their markets to the world, and that's very important. So India was quite a closed off market. It was a very controlled market at one point. They didn't have a lot of exports and imports either. So they had everything, almost everything made in India. And we studied this when we were in business school. So it was something done a long time ago. And there were a lot of capital controls and exchange controls. A lot of that is easing up. And I think that's where, you're going to see a lot of foreign capital come in, a lot of investments come in, and that will sort of help drive the next leg of the economy.
Very good. Yeah, it's one I haven't invested in, but as I said, I almost feel like I've missed the boat a little bit with Indian equities. But yeah, it's certainly performing really well. Um, Now to close, or as a final question, I've heard you say before that it's a superpower who you choose to listen to and learn from. So right now, yeah, who are you listening to and learning from in terms of macro and trading?
Oh, that's quite a question. um, so yeah, I mean, there are quite a few good people out there, and you don't have to learn all their views uh, or learn from all their views. But I think some of the more solid people. So I like, it's a difficult question you asked me. I like.
It's okay. You can say yourself, but just
Well, yeah, I do a lot of the research, and look, there are various people in various banks also that I listen to. So I still do listen to people from Morgan Stanley. I really like Mike Wilson, even though he's been wrong for a bit. But I don't think his arguments per se have been wrong. I do like some people at Goldman. Actually, Goldman Sachs, the team is pretty good. Although they're quite optimistic on the economy. In terms of private people, I do like Hedgeye. They do their work very well. They're very diligent in what they do. And I do learn a lot from them, the whole team.
super. Thank you so much for your time. Yeah, I really enjoyed it. It was brilliant.
Thank you.